While everyone was arguing about headlines, the US dollar just blinked first, and the moment it blinked, silver didn't go up. Silver launched. Today, silver printed a fresh record near $95.87, and even after it cooled, it's still living in the mid-90s. So if you're asking, why is silver going to the moon? The answer isn't one thing. It's a chain reaction. A revived Sell America trade, a credibility crisis around US policy and US debt, and the worst part, silver is not just money anymore. It's a fuel line for the new economy. When you mix people dumping dollars with factories needing silver, you don't get a normal rally. You get a squeeze that looks like a moon mission. If you like narratives that connect geopolitics, markets, and real-world supply chains, subscribe, because this story isn't ending at $100. Quick disclaimer, this is commentary and education, not financial advice. Picture the trading floor in your head. Screens flashing red and green, a headline hits, a bond trader mutters, "Are they really doing this?" A currency trader slams a hotkey, "Sell USD." And somewhere else, an industrial buyer looks at the same headline and thinks, "I need metal, not opinion." That's the world we're living in. One headline, two different buyers. And silver is the meeting point. What Sell America actually means. Let's define it like a story. Sell America is not a slogan. It's a trade. It's what happens when global money managers decide, I don't want US risk right now, and I don't trust the rules. And it's not theoretical. Reuters described the dollar sliding as the Sell America trade revived, with US assets getting hit after renewed Greenland-linked trade threats. That matters, because when this trade is on, it's not just currencies. It spills into US stocks, US treasuries, and anything priced in dollars. So when you hear the dollar weakened, don't picture a gentle drift. Picture global capital stepping back like the floor is hot. Why the dollar move was different this time. A normal dollar move is about rates. Inflation up, Fed hawkish, dollar up. Inflation down, Fed cuts, dollar down. Simple. But today's move had a different smell. It wasn't rates. It was risk. It was trust. Because the market wasn't debating CPI. The market was debating, can alliances, policy, and financing hold together at the same time? And when trust gets questioned, you don't get polite repositioning. You get urgency. Why this is scary when America is the risk. Normally, in a crisis, money runs into the dollar. That's the old script. The world panics, and the dollar becomes the lifeboat. But when the headline is about the US escalating pressure on allies, the lifeboat becomes part of the storm. That's how you get something rare. Fear rising, yet the dollar slipping. Reuters described the move as a broad sell-off in US assets, stocks and treasuries included, after the Greenland-linked threats, with the dollar falling toward multi-week lows versus the euro and Swiss franc. And when US policy risk becomes a global headline, the tremors don't stay in New York. They ripple through the currency complex. Just look at how fragile the mood is. Reuters reported the Indian rupee hitting record lows amid Greenland-spurred risk aversion. You don't need to trade the rupee to understand the signal. It's the same message in every market. Confidence is being repriced. So the Sell America factor isn't anti-American. It's pro-certainty. Investors will tolerate almost anything, except not knowing the rules tomorrow. The Greenland trigger. Why this feels like a geopolitical divorce. Now here's the spark that turned a normal risk-off move into something violent. President Trump has threatened tariffs on multiple European allies tied to the Greenland dispute. The structure being discussed is a 10% tariff starting February 1st, escalating up to 25% by June 1st if the standoff continues. Think about the message that sends to the world. The US is willing to tax its closest partners to force a geopolitical outcome. That's why the market reaction is bigger than trade war fear. It's alliance fear. Because if your closest allies are being treated like leverage, then the next question becomes, what happens to the trust that holds the financial system together? And yes, there are reports and analysis around increased NATO posture in Greenland tied to Operation Arctic Endurance, a Danish-led exercise signaling resolve. So investors aren't just pricing a tariff, they're pricing a fracture. How a weaker dollar mechanically lifts silver. Now let's talk mechanics, because this is where most people get lost. Silver is priced in US dollars, so when the dollar falls, it takes more dollars to buy the same ounce. That's the basic math. But in this move, the dollar wasn't just drifting, it was sliding toward multi-week lows against safe havens, while the euro and Swiss franc surged on renewed fear. Even the DXY snapshot around this moment shows the index sitting around the high 98 range. So the currency tailwind is real. But here's the twist. The currency tailwind is not the rocket. It's the ignition. The real rocket. Silver is money, plus metal at the same time. Gold can play safe haven without any factories calling. Silver can't. Silver is both. A financial refuge when people lose confidence in paper, and a critical industrial input when the world is building electrification, solar, EVs, data centers, and defense tech. So when fear hits, gold rallies. When fear hits and industry keeps buying, silver explodes. That's why, in the same breath that gold pushed to records above $4,700, silver tagged that 95.87 print. It's also why silver's move has been relentless. Reuters noted silver surged about 147% in 2025 and has already gained more than 32% since the start of 2026. This is the heart of the story. Silver is acting as an anti-dollar, but also as an anti-shortage. The two buyers, fear versus need. In every historic silver run, you can hear two voices in the market. Voice one is fear. I don't trust the currency. This buyer shows up when the dollar wobbles, when politics turns chaotic, when debt headlines get louder. Voice two is need. I can't miss delivery. This buyer shows up with purchase orders, deadlines, engineers, and production lines. Fear can disappear overnight. Need can't. That's why silver doesn't behave like a normal safe haven. It's not just a store of value, it's a bottleneck. And bottlenecks do something strange in markets. They punish delay. They turn hesitation into a tax. They make the late buyer pay for every hour they waited. Paper vests physical, the part nobody likes to talk about. Here's a truth most people only learn the hard way. The price you see is often a paper price. The pain happens in the physical market, because if you're a hedge fund, you can trade contracts all day. But if you're a manufacturer, you can't solder a solar panel with a futures contract. You need atoms. So in a stress moment, the market splits into two worlds. The traders arguing about charts, and the buyers arguing about delivery. That split is why silver moves like a wild animal. A tiny shift in perception can create a stampede in paper, but a tiny shift in availability can create a real panic in physical. And that's why To the Moon isn't just hype. It's the market admitting, this metal is not optional. The curve. When silver starts paying you to wait. Here's a nerdy detail that becomes a siren in moments like this. The futures curve. In a calm market, future delivery is usually a bit more expensive than spot. Why? Storage, financing, time. But in a stressed market, it can flip. Near-term metal becomes so valuable that the front end trades richer than later months. That's the market whispering, I need it now. That's why watching only spot is incomplete. You want to watch whether urgency is building in the front month, and whether spreads stay tight when the headlines hit. And pay attention to what big research desks are willing to say out loud. In recent coverage tied to these Greenland tensions, Reuters noted analysts at Citi remained tactically bullish and pointed to a $100 silver target on a short horizon. So when people tell you $100 is impossible, remember, markets don't care what feels possible. Markets care what must be delivered. Why Greenland matters to silver, even if you never go there. Now let's connect Greenland to silver, because people hear Greenland and think it's just politics. But Greenland is not just ice, it's leverage. The modern economy runs on critical minerals, and the Greenland dispute is being framed in markets as a fight over access, control, and future supply chains, especially for minerals tied to green tech and strategic manufacturing. So you get this feedback loop. Step 1, trade threats rise. Alliances wobble. Dollar confidence softens. Step 2, dollar softens. Metals priced in dollars rise. Step 3, the same geopolitical fight highlights mineral scarcity. Industrial buyers get more urgent. Step 4, urgency meets thin supply. Silver becomes the battleground. That's why this move looks parabolic. It's not a chart pattern first, it's a supply chain reflex. The treasury problem, why this is really about confidence. Now I want you to look beyond silver for a second, because silver is the symptom. The disease is confidence in the US Treasury market. If global buyers ever hesitate, if they demand higher yields, shorter maturities, or just reduce exposure, then the cost of funding the system rises. That's when Sell America stops being a trade and starts being a cycle. This is why markets react so hard when Washington projects uncertainty. It's not morality, it's math. Because treasuries aren't just bonds. They're the collateral foundation for global finance. If the foundation gets questioned, everything on top gets repriced. The 3 lies people tell themselves about silver. Let me expose the traps, because this is where viewers get wrecked emotionally. Lie 1. Silver is only a safe haven. No, it's a safe haven and a necessary industrial ingredient. That double identity is why it's explosive. Lie 2. Silver is too small to matter. Exactly. Small markets don't absorb fear gently. They gap, they jump, they overshoot. Lie 3. If silver drops $3 in a day, the story is over. Wrong. In stress regimes, volatility is the feature. Volatility is how the market transfers metal from weak hands to strong hands, why $100 is not a meme anymore. Now let's talk psychology. At $30, people debate. At $50, people notice. At $80, people get emotional. At $95, institutions pay attention because it's telling you something is breaking. And once an asset prints a new record high, the next round number becomes a magnet. $100 becomes less of a prediction and more of a test. Can the system provide enough real metal at that price? Because if the answer is no, you don't get a clean breakout. You get a scramble. What could stop the moonshot? Here's balance, because a real strategist always asks, what breaks my thesis? 3 things can cool this down. A credible de-escalation headline, not a rumor, not a maybe. A clear walkback on tariffs, or an agreement that lowers the temperature. A sharp reversal in the dollar. If risk sentiment flips and the dollar catches a bid, silver can breathe out, hard, a sudden tightening of financial conditions. If yields spike fast or funding stress appears, leveraged paper positions can get forced out, causing violent dips. So don't confuse bull market with straight line. Moon missions still have turbulence. The checklist, how to track this without getting fooled by noise. If you want to follow this story like a pro, stop staring at one candlestick and start watching the plumbing. Here's your simple checklist, the dollar and safe havens. If the Sell America tone stays alive, watch Euro, Swiss franc, and the DXY trend. Treasury stress, watch auction demand, bid to cover, and whether long yields jump on risk headlines. The tariff timeline, Feb 1 is the first tripwire. June 1st is the escalation point, the geopolitical temperature. Any hint of de-escalation can cause sharp pullbacks because the fear premium comes out fast, but if tensions persist, dips can become accumulation windows for bigger hands. Silver's behavior relative to gold. If silver outpaces gold during risk-off, that's the industrial bid showing its teeth. The real-world signals, watch premiums, delivery delays, and corporate language. When companies start talking about security of supply, the story gets serious. What this means for regular people. Now, if you're watching this as a normal person, here's the takeaway. When a currency weakens, your purchasing power is the hidden casualty. And metals, especially silver right now, are where the market is screaming that message out loud. This isn't about being bullish. It's about recognizing the regime shift, a world where alliances are stressed, policy is weaponized, and hard assets are repriced as protection. Don't let the chart hypnotize you. This is a headline-driven regime, so your edge is calm. If silver rips, ask, did the dollar slip? Did bonds sell off? Did the tariff timeline tighten? If silver dips, ask, did tensions cool or did paper just flush? Remember the rule, price is opinion, delivery is fact. Keep a notebook of the triggers, not the emotions. And if you're new, promise yourself one thing, no revenge trades, no FOMO buys. You're here to learn the cycle, not chase it. When the crowd screams top, ask the quieter question, who still needs metal tomorrow morning? That's the whole game. So, here's the story in one sentence. Silver went to the moon because the world started selling the dollar at the exact moment the world cannot function without the metal. If you want part 2, comment one word, moon. And tell me this, do you think the first crack shows up in the dollar or in treasuries? Subscribe if you want the next update the moment the next headline hits.